Thanks for joining us this afternoon for what we're calling Transparent VC. Before we get into who we are, just want to talk a little bit about why Ryan and I decided to hold this session and what our intentions are and what we hope you guys can get out of it. Both Ryan and I are relatively new investors into Minneapolis and the upper Midwest, probably anywhere from a year to a year and a half of being active in the community. And there's a lot of awesome things going on, but some of the feedback that we've gotten from entrepreneurs when they've met with us is a lot of questions around what sorts of opportunities are resonating with investors, what does a deal look like, and what are some things that work and don't work while we're fundraising. And I would say that the intention of all of this isn't to be any preaching about what you should do, or things that people are doing wrong. It's just more about observations from where we've been spending our time. And if any of that can help any of you along the way, we think that's all for the better. And we're pretty informal folks, so if there are any questions while we're talking, go ahead and interrupt us. Otherwise, we'll just have some Q&A at the end. So the stuff that we're going to cover, like I said, is first, what's resonating with investors, market, business model, funding history, traction, stuff like that. Getting into deal construct and coming back into some tactics. I myself, my name's Patrick Meenan. I work for Arthur Ventures. Arthur Ventures is an early stage venture capital firm based in Fargo, North Dakota. I'm here in Minneapolis. We've got an office downtown. We're currently investing out of our second fund, which is $45 million. And we're most often investing anywhere from $250,000 to $3 million initially. In Series A rounds, typically of 2 to 5 is what we've been doing. So we do some deals by ourselves, some with some other folks. We've done 7 deals since we closed the fund, 3 of which are outside of the Midwest. We've done 1 in Phoenix, Seattle, and Philadelphia, and then 4 in the Midwest. So 2 in Madison, Wisconsin, and 2 in Minneapolis. And the ones in Minneapolis were this clicks in lead pages. So if any of you guys know Clay or Chad, we've been lucky enough to work with them.
Yep. So, and I'm Ryan Broshar. You guys, there's some chairs over here and up front. It's fine. I'm Ryan Broshar. I'm with Confluence Capital. I'm the managing partner, founder of Confluence Capital. We've been around about 6 months now, and we do seed stage investments. So we typically write checks 25 to 100K in various tech, web-based technology companies. And most of our investments thus far have been in Minneapolis so far, but we are sourcing deals out of Boulder, Chicago, Austin, Kansas City, really anywhere in between there. Besides that, we have made 1 out-of-state investment so far, but we are Twin Cities based, relatively new, and looking forward to meet as many people here as we can. But I'm excited to get into this topic. I think Patrick and I were kind of brainstorming before this of like, hey, what's a good thing we were talking about, and we tend to see a lot of entrepreneurs come to us and just really think that this is like this black box of like venture capital, and like there's all this like secret formulas and voodoo behind everything, and it's really not the case. Like, and I don't think that that's the type of venture capital that we want to put out there either. So I think it would be an interesting conversation, and look forward to your guys' questions throughout this.
And that's what we wanted to do together. So Ryan's typically investing in what you would call the seed stage, right? Mm-hmm. So you guys are typically, what's the size of the rounds that you guys are typically doing?
We've invested rounds anywhere from $150,000 up to a $3 million round.
Okay.
As well. So yeah, we invest in companies so they grow, and then Patrick can invest in them later.
Yeah. So just one other thing before we get in. I think that the point of this is to answer any questions like we would answer to our own investors. So outside of specific deal terms of companies we've invested in, everything's on the table. So starting off with market, some of this stuff's going to be pretty straightforward. Other might be new. What we've been seeing in terms of what sort of markets are resonating the most. When I talk about market, I would say software, hardware, businesses, or healthcare. I would say it's probably no surprise to anyone in this room, the stuff that we've been seeing in terms of deals getting done that either we've done or we've seen other firms do is primarily in the B2B market. I think that's pretty well documented, that there's a lot of traction in B2B, more so than B2C, which is selling software to consumers. And then on the healthcare side, there's a little bit more traction recently in software versus devices. And so I would say, and interested in your opinion, on why that shift, is kind of focused on B2B versus B2C, I would probably attribute to most people having success in B2B sorts of businesses in the upper Midwest, thus having some familiarity with it.
I mean, it's no surprise. I mean, we're in we have the most Fortune 500 companies from west of Chicago, east of California, and north of Dallas, and really the most Fortune 500 companies per capita. And all those Fortune 500 companies are great, but it's all the smaller companies that filter into those companies. Those are the ones that a lot of these companies are starting to service right away. And I think that's really where it resonates for the B2B market. And I think there's something to be said, too, about the startup communities in and of itself. Of a lot of early stage startup communities start out of B2B because it's really business to business on that, where you can't really get the spotlight on the community to do large B2C plays. And I think where you really draw a light on to, where you need millions and millions and millions of customers versus other businesses that you're working to. So I think we're in that earlier stages of the B2B, and I think we're in an incredible position based on where our Fortune 500 companies are here and the service organizations that are servicing them to really help bring up a lot of these new startup technology.
And one other thing I would say before we get into business model is, I think part of it is also all the trends are well documented around cost to start a company. It's more cost efficient now to ever launch an enterprise. It's a little bit easier to get your first customer. I mean, businesses will buy software off someone's website. I mean, that just wasn't really happening 10 years ago. So I think what's happening is that since it's easier to get traction within the B2B space, if an investor is looking at a B2B company and a B2C company in the upper Midwest, I think they're more likely to go with the company that has paying customers and a little bit more of a capital efficient model than a B2C market.
Yeah, and I think talking to any entrepreneur, any other investor too, is just like the capital here is more conservative, right? And they want to see those cash flows coming in, and the amount of deal flow is not comparative to Silicon Valley, but I think the quality of the deals and the companies here is definitely on par with any other market. So there's definitely a trade-off, I guess, when it comes to that, but I think it's in a great position for it.
And then why don't you talk a little bit about what sorts of business models that you've seen within the software space?
Sure.
Get the most traction.
Yeah, well, obviously the SaaS model is the hottest thing right now, software as a service. So I think the main reason with the SaaS model that, and you know this as well as I do, but it's really easy to see the traction, and you can really prove the metrics out on what that company is actually valued at throughout the life cycle of the company. So if it starts out at an early stage and you've only got a few customers, you can really model that out quite nicely from the venture side of it, of saying, okay, there's some really tried and true metrics out there of like certain milestones you can hit throughout that. So the SaaS model is obviously the lowest hanging fruit for a lot of that. We're seeing some other transactional-based companies here in the Twin Cities and beyond that are, where they're taking small percentages of a lot of different transactions or various items goods that are being shipped. That's a little harder play, I would say, definitely around here, unless you are unless you are doing a B2B play on that, just because we have, like I said, we have a lot of companies around here that you could potentially run a lot of transactions through. But I think the key with that model is showing the traction on it, because you've got to have, literally thousands, hundreds of thousands, millions of transactions really to get those models up to where they are. So those are a couple we've been seeing. How about you?
Yeah, and I would say one other thing that I would add, at least that's probably surprised me a little bit, is we've seen a lot of companies that have gotten funded, either within our own portfolio or, like I said, other companies that we haven't invested in or haven't had the opportunity to, which are kind of lower price point, higher customer volume opportunities. I think you saw one in the Piranha Pool today with Elevate, right? I mean, they have a lower price point of something like 10 or 12 bucks a location, but you can multiply that by a lot of locations, and it provides a little bit more visibility. So I think that, perfect example, I think both ThisClicks and Lead Pages around the time we invested had around 3,000 customers paying like 30 bucks a month, like 30 to 40 bucks a month. And when we met with those companies, we weren't like, hey Clay, why doesn't P&G use Lead Pages, right? We weren't going for like the big brand names. It was more just around like quantity of customers that you have. So I would say all things created equal from what we've seen, like, the company that has like $1 million in revenue, and they've got 3 customers, and it's like Best Buy, General Mills, and United Health, each paying $333 grand a year, is a little bit less appealing than the company that has, $30 a month price point, but 3,000 customers. And you can see exactly how they're acquiring customers. So I would say if you have a business, I wouldn't, it's great to have big customers, with awesome logos and Fortune 500 stuff. But I wouldn't feel like you have to go beat your head against the wall to to like try to go get Target or something like that. I think that it's not necessarily each, I don't think it's exactly equal. And I would say that's probably one of the biggest things that I've seen in terms of the business model.
Well, I think that model helps a lot too, because actually, I mean, beyond like having, thousands of customers, you can also, as a startup, you can iterate your product that many more times when you have 1,000 people looking at your product versus 3 people looking at your product, and they're all using it multiple times. So as a startup, hopefully you're iterating your product, coming out with new advances, every all the new updates. And I think that's another side of it beyond like the valuation is the actual value that you're creating in your product. Having those thousands of customers, they're just going to be hitting you hard if something goes wrong and you have to update it quickly versus a one giant customer and you do something wrong and they're upset and then you lose that customer and there goes half your your revenue for that. I think you work your way up to those customers for sure. And those are like the holy grail, but make sure you know what you're doing before you get into some of those companies right away.
Yeah, so far I would say that if you're following the stuff that we're saying, that what we're seeing to get the most traction right now in the upper Midwest is B2B software companies, those that have a high volume of customers. I'm sure that's not exactly shocking, but you're not getting penalized for who those customers are. And then what about funding history?
Yeah. Well, where we invest, we're typically either right after friends and family or founder money after that. So for us, the funding history isn't as important as it is, what are you going to be spending the money that we do invest in your company? What are you going to actually use it for going forward? I think the funding history is probably much more on your boat as far as what they've raised and what valuations it is, and hopefully you haven't priced yourself out of the next round or the like. So
yeah, I would say of the companies that we're investing in, we've probably partnered with a lot of bootstrapped entrepreneurs. So I think us, the less amount of money that a company has raised, the better. We do see a fair amount of companies that have come to us and they say, hey, I've got $1 million in revenue, but it took me $3.5 million to get there. Typically, that's a little bit harder to do. I think probably the best thing from a funding standpoint that any business can ever do is basically build a business that doesn't require venture capital to succeed. Because I think that as you build your business and you don't have to take on investor money, you kind of control. You can control where you go. So I think probably the easiest deals that we see get done are companies that have raised $1 million or less in funding or have been bootstrapped today.
Yeah. Easier said than done.
Yeah,
right?
So far all you have to do is get a company with thousands of customers and bootstrap while doing
Yeah.
it. So,
Yeah.
but I think what the point of it though is that of the companies that we are seeing get funded though, those are the companies, whether it's Minneapolis, Chicago, Madison, Omaha, whatever. I mean, those are the companies that have had multiple venture firms going after them, trying to give them money. And so I do think it's important as entrepreneurs are out like considering to take on capital. Is just kind of how you stage that stuff in.
I think from a funding history perspective too, for Confluence, it really matters. Since there's not much of a history, it's usually your rich uncle or your grandma or something that's invested before we come in. That's okay, but for us, it's more of like who's coming into the round with us. Because I think there's something to be said about bringing money into your company, but there's also if you can bring in some smart money into the company of like strategic investors at an earlier stage, I think that's a huge benefit, and will definitely help you along the line for your future rounds and getting those customers that you're asking for right away. So
why don't you talk about team? Oh, sorry.
We have a question.
I think this what you said earlier, maybe that's something nowadays the technology is going different. Is the time to market for any of the technology product and the advantage that you have to get to the market quicker and capture is getting shorter and shorter.
For sure.
So that means that the need for venture capital is really greater. It's not like, so yeah, we can say we can go and get the customers first. But by the time you got the product out the door, the very next day there are 100 people who are working on it,
Yeah.
And what kind of protection you get from, the USPTO office or any of such kind of intellectual property protection, very limited.
Yeah.
So I think that, it's more and more needed, especially for the larger scale technology projects, is to go for venture capital early rather than kind of trying to bootstrap and get 1,000 customers and
But I think it depends on knowing your metrics and knowing what you're going to do with the capital, right? Because I do think there's something to be said about being patient and actually understanding why your customer is buying and what channel you're getting them through. So like one example is with ThisClicks, Chad Halverson, I believe that it took him 3 years to get to $25,000 a month in revenue. and he did that while he was working at an agency, right? But at that point, he started realizing the channels that he could plow money into, and he basically tripled that amount of MRR in like 9 months, right? So it was kind of one of these things where it was going like this. He figured it out. He was able to do that on his own, right, before raising the capital. But to your point, it is interesting on once you realize you have that fit, raising can really help you accelerate that. Because for a lot of these companies, it's not IP protection, right? So much of it is just momentum. I mean, you can compare like, I'm sure there are details, but you can compare like ExactTarget, HubSpot, Marketo, all these large marketing automation players. Like what really is that different between what many of them do? A lot of it is just speed to market, getting customer traction and building on that.
Yeah, and very good example is, iPhone 3, when Apple launched it. Before Apple could actually get to the market, there was a fake iPhone 3, came out of China. 2 weeks before or 3 weeks before the actual launch. I mean, that's the speed at which things are happening. And
For sure.
the end.
We've seen multiple times. We actually looked at a company in Madison. That literally, when I was trying to find something on their website, I went to a competitor's website and it looked identical. I mean, literally down to like the skin of the website and the logo. So I do think that it's a pretty, it's a good observation, right, for sure. Do you want to talk about team a little bit?
Yeah, definitely. So obviously, I think there's something to be said about when to raise your venture capital. I think a lot of it comes into when your team is formed and when your product is there and the like. So for us at an early stage, the team is 75% of the reason that we invest. Obviously beyond the product and the market and what you're doing, but you invest at such an early stage, you need to know that entrepreneur is going to take this company and go somewhere with it. It may change, it may mold, it may go somewhere else or whatever, but they're going to take it and run with it and be with it. So, there's the entrepreneur team that is around that is a big deal. But, what is in that team? Like, what are we looking for? We know, for us, there's definitely a need for a team, first off. If it's a one-man show, entrepreneurship is a lonely, really hard game to play, and I know this from having done it a couple times, but you need someone else to rely on, and you need someone else to rely on for not only moral support, but obviously for all the skills that all those other people can bring to the table. So,
What about the tech side?
yeah, so I think definitely the companies that we invest in, there has to be some sort of in-house technical co-founder for this. Just because the same reason that you get so many customers and you start to iterate, all that stuff. I think the technical co-founder allows you to iterate and allows you to improve your company back and forth versus hiring out of outsourcing your tech side of that. I think you can do some outsourcing of your tech stuff, maybe to get to some early prototype, but you're probably going to have to fund that with friends and family money to get to a certain point of it, and then hopefully draw in some sort of technical co-founder that's interested in what you're doing and then can run with it. Because I think once you get venture capital involved, that venture capital money is not going to want to go into the company and then just go straight out the door to a design company or to a developer out of house. And I think it allows you to move a lot quicker, as you were saying, and iterate those products. So technical co-founder, and I think you got to have someone who's really on the front end of the business side of it too. Like they got to understand who the customer is and be able to talk to them and have had interactions with those customers and actually had talked to them and the like. So we've found really good success with companies that come from an industry. They're living in an industry, they work in an industry, and they recognize a problem in that industry, and then they decide, hey, this problem here, I'm going to leave this industry, I'm going to create a solution and bring that product back to the industry. And now that's a nice kind of low-hanging fruit scenario. So I think KidBlog is a great example. We invested in KidBlog. Obviously Matt and Dan are, Matt for sure, definitely teaching background, teacher recognized his problem, left the company, built his solution, and now he's going straight back to teachers and providing that solution to them. And I think that's a great story because he really knew right away. If you're trying to create a solution for something you don't really know, you're going to have to iterate that product so many more times and then try and figure out who you're selling to, what their real problem is, and then change your product to it. So having those team members with either certain technical skills and or backgrounds that allow you to move forward quickly, I think are essential and or very, very helpful at the beginning, especially for a startup.
The only thing I would add is I would probably say go for talent, not proximity. We've seen plenty of the companies we've invested in. Lead Page's technical co-founder lives in Prague, right? I mean, Clay, like, I met him at a conference, and he's like, wow, I get along with this guy, and he's fantastic. I want to work with him. And like, I couldn't have given two shits that the guy was in Prague, right? I cared that when I talked to him, he just really knew his stuff, was totally, bullish on Lead Pages, and was willing to join the company full time. So I think that's probably what I would do at the earlier stages, especially when you're trying to differentiate yourself. If you've got great talent right next to you, that's awesome. But if you don't, I think it's okay to try to find other people in the market.
iFighter's CTO is in Paris. He works on it full time.
So apparently you should move to Europe.
Yeah, look at Europe for CTO.
Cool, so just on that stuff, tying it all together, and again, I know it's obviously not an easy thing to do, but of the deals that seem to get the most traction, it's been B2B software companies that have significant customer traction, hopefully a little funding history, and a few members of the core team. And we've probably seen that multiple times on good opportunities. So just want to get a little bit into deal construct in terms of.
Should we open up some questions?
Oh yeah, sorry.
See if there's anything on that. Yeah.
So talk about where you guys get your money from, right? Where the venture capitals come from, or the money, because obviously you do seed, not seed, I forget what they call it, rounds, where you raise like X amount of money and then you distribute that.
Yeah.
Talk about that, because I'm not clear on that.
We did all our money from Bitcoins. We just
That's a good one.
No, it's actually eerily similar to anyone who's trying to raise a round for their company. I mean, you have to go out, you have to meet with all your limited partners, and you have to pitch them, tell them how you're going to invest and the like. So we have limited partners, basically investors into our fund, and then we invest that capital based on certain areas that we see.
And you identify a focus of that fund typically too?
And so it's like what a fund will do is they raise at a point in time. So like we won't raise money on a deal by deal basis.
Yeah.
So we'll go to market and say we want to raise X amount, and here's what we want to do with it. So we went out to investors and we said, hey, we want to raise this venture capital fund. We're going to invest it over 5 years. We should be returning capital to you over the next 10 years, right? So we don't like get all the money up front. So we don't have $45 million sitting in a bank account with Fargo. It's like we call it over time, and so we'll basically call probably 20% a year. Then we basically have that capital that we'll go invest.
Do you have a certain number of deals that you have to do a year per those?
No, we don't. We don't have a certain number of deals we have to do. We probably target about 20. Is what we'd like to do. And they vary over size, right? We've got some investments of $500,000, some of $3 million.
And then what about tax incentives or structuring how you would do those? For example, when my company got acquired, part of it was that they got a tax bonus at the end of the year if they had acquired a company. It was a goofy balance.
Okay, no, I haven't had experience with that. But I mean, what's important to an investor though, like we won't invest in anything that's not a C Corp, right? Because if it's a limited liability corporation and those gains or losses pass through, we have to pass that through to all of our LPs and their multiple and stuff like that. So that'll come up, but that's typically part of the deal where you'll basically say contingent on close, you have to convert to a C
Yeah, I'm
Corp.
sure that was like a one-off term or something that they.
Yeah, it was like a California thing.
Yeah. Any other questions?
Go ahead.
This might be a really stupid question, but so you're talking about how you guys invest in businesses or startups who like already got funding, or you have like a certain threshold, like you said, like 300K. Like if I'm looking for funding, like for starters, like and I have pursued funding elsewhere already, like where do I go? Is that like where I go to like my friends and family and put up my like rich hand and ask for funding, or do I go to somebody like one of these many different investors who have different sort of categories that they like to kind of account themselves?
Yeah, no, it's a great question.
So that's probably more in my realm, for where to go. And I think depending on if it is to the point where it's where you should take some sort of venture capital or the like, is probably a lot to do with your traction and your team and the like. So it
depends on how much though too though, right? I mean, I feel like
True,
if you
yeah.
get to 20, it depends what you're looking to raise, right?
Yeah.
I mean, if you're looking to raise like, I met someone the other day who's like, I need to raise $5,000. And I'm like, no one's going to write you a check for $5,000 other than, I mean, that's fine, like other than like maybe a family member, right? But I think that you guys invest from 25K and up.
Yeah,
right?
into rounds that are much larger than that. So
Bigger.
yeah, it's like you gotta raise a significant amount of money to really draw the interest because like you said, you can't write a $5,000 check for not paying $5,000 basically for legal fees in the deal, so.
I would probably say if you're raising
Like 100K.
like 100K, yeah, it's probably individual angels.
Yeah, I would say friends and
That would do that, right? So whether it's friends and family, or there are some other angel investors that, and you can kind of track who's done deals, feel like Tech Dot and stuff like that, and ask around. If it's 100K, it's probably more of a friends and family sort of thing. I think if you get closer to $250,000 is when it actually talk to someone like Ryan or other folks.
It's a lot of work making the trip to go around and finding VCs and do
Yeah.
invest in your business. Then you get VCs to chase you rather than you chasing them.
Yeah, no, it's a
And,
great
and
question.
what advantages might you have in doing that in terms of the deal?
Yeah, no, I think it's a great question. I think that there are a few different things that you can do. One is, when you're ready, put stuff out there, right? I mean, there are a lot of things you can do. You can talk to guys like Pesic and get like a blurb in Tech.men about your business. I mean, investors are tracking that stuff, right? I mean, it's what they read. That's how we found, we found this clicks through an interview while they were going to the Minnesota Cup on Tech.men. We found lead pages actually from a panel that was on Tech.men of a panel that Clay was on, basically talking about how like venture capitalists were idiots. Is like where we found them, right? And so I think that stuff matters. I think put your stuff up on angel lists. I know Andy, my colleagues here, will look at different markets, right? And be like, I'm gonna go to Cincinnati and see who's got a profile on angel list and might be raising. I think if you put it out there, people will find it. I also think reach out. I think people really overthink how to get an investor's attention. Like most of them have their email addresses on their website and like they're paid to find opportunities. So like they might say no, right? But I mean, a lot of times, my email address is on our website. I think that we try to reply to most qualified opportunities that come through. But I think that people, I think there's a lot out there to do to get the word out.
I think I think the VC community and investor community talk too, right? There's a lot of talk that goes on kind of behind the scenes. So the more you can get the different points in those communities and/or not overlooking the other communities too, like looking into other markets to raise money, because even there's a lot of talk that goes on between those markets too.
For
It's
sure.
like, hey, what deals are you seeing? Like deal flow, and is there any rounds to close out? And that all that conversation happens.
Ask
So
for
the-
referrals.
Yeah,
too, for sure.
referrals and the like. I mean, we're not in Silicon Valley, so it's not like there's like a million VCs right here and everyone's just closing conversation and like. It's like the Midwest is a very collaborative, investment scene. So.
How many applications do you receive normally? I mean, what's the volume that you deal with?
How many?
We see 5 to 10 companies a week usually. Is where we are, yeah.
600.
600.
Yeah, 600 a year.
A year.
And that excludes like spam and stuff, which
Right.
Andy actually one time got a voicemail from someone asking for a loan for 75K because they had to pick up a package at the airport and he needed cash up front. What's the IR on that? And then he also asked him for a ride.
Yeah.
But, go ahead, Derek.
Did you take it?
Question about deal structure. So
Yeah, it's a good
convertible notes seem to be very popular.
Yep.
And I think there's some advantages to that. But if you were at the Piranha Pool session earlier today, you heard multiple investors say, I'm not interested in a convertible note, I want equity in the company. So interested to hear your take on the pros and cons of a convertible note.
I think the pros, we recently did a safe note, which is basically a convertible note without debt. So you should research that too. There's some great stuff on the Y Combinator website. It was nice, it doesn't have term and stuff like that, but same idea. I think the primary benefit is speed and being able to kick the valuation discussion down the road a little bit. I think one of the reasons that people don't like doing convertible debt, a lot of it depends on the terms, right? So there's a very clear cap. I think people can kind of get their head around it. If it's just an uncapped, like, hey, this converts into the next round, that's basically you're taking all the risk for paying the same valuation someone else will down the road. So at least from what I've seen, it's typically more around the valuation cap versus the concept in general. And one other thing is that when you invest in preferred equity or common equity, whatever, and you actually get shares, right? So when you're in a convertible note and someone else goes and raises the next round, there's always some kind of risk that that investor could try to renegotiate terms of the note since equity hasn't been issued. But at least that's what
Yeah.
we've seen.
I think, the data is showing that I think 100% of all Y Combinator companies coming out are financed through convertible debt. I think it's like 80% 80% of tech startup companies are coming out with convertible debt. And like I said, it's just a sheer matter of, I think it matters what stage you're at as well, because if you're bringing a lot of different players into the table, convertible debt's a lot easier versus having to raise an equity round and then everyone has to be board members, or then you have certain warrants and the coverages and like all this stuff that goes into it. Whereas if it's a convertible debt note, I mean it's literally like a 2-page document. And there's really only 3 things that change on all of them. And so it's a really easy document across the board. And we've invested in a lot of convertible debt. We've also invested in equity rounds for it. And I think it just matters of how it comes together for which one we choose. But there's obviously pros and cons.
And to be fair, we've done, of the 7 investments we've done, 6 have been priced. So we've only done 1.
Sure.
9.
Later stage ones tend to be priced more,
Yeah.
and especially if, like for you guys will take the whole round or something.
Yeah.
Then there's less incentive to, because you're going to be the board member, you're going to be that
Yeah.
person versus like trying to work it out with
For sure.
8 people or something.
And then, Joy, what would you say on the note thing? Does that sound similar? Because you were one of the folks who said that you wanted to not do the note.
I think it's exactly what you said. I think
Okay.
the fear is that the next round comes in and either changes the percentage
Ambiguity,
discount,
yeah.
or that it's so long that the valuation has increased so much more that you would have been better to price it at the point when you made your
Exactly.
investment. But I think
Exactly.
you're right.
And then since I just want to make sure we can talk a little bit about deal structure a little bit more. And I would say that, tying it from like traction into different funding rounds,
Yeah.
I think maybe we should start at like Series A and then bring it back to seed. What we're seeing most in the market is that once a company gets to about 30 to 40K in MRR, they've got the capacity to take on like $1 million in terms of funding. And then we kind of see that cap out towards like deals that we've been doing about 100K in MRR, been able to sustain checks of like $4 to $5 million. And so the reason we've been seeing that kind of that range is that anytime you go and do a meaningful round, I think it came up in the pitch event today, investors typically want to own 20 to 30% of the company. And so if you look at it, a lot of the deals that we've seen that are around 40K-ish MRR have been priced at around like 4 pre if they have a competitive scenario. And so if you kind of back into the math on what a round would look like, typically someone's taking in like $1 to $1.5 million. I think the reason that's important is that if you have a business and it's around 30 to 40 to 50K MRR, and you want to go out and raise like $5 million, the economics probably aren't going to work. And I think that you'd probably be surprised at how often we see that. And then a lot of the companies that we've seen go out and raise $4 to $5 million have been typically at kind of the top end of that range of 9 to 10, around valuation. And so I think that the takeaway there is, I don't know if people are looking at it from a revenue multiple perspective or not, but tracing it back to deals we've seen competitive deals that have been priced by us. We've seen competitive deals that have been priced by other national firms. We've seen deals we've lost out on or deals that we passed on. For some reason kind of shake out in like the 10x run rate scenario when they're competitive. So I think that if you have a bootstrap business or a business with minimal capital and you're going out to raise a round, sometimes that can be a safe metric to have in the back of your head. So we were really far along with the company who was doing like 30K in MRR, and they said our pre-money valuation's like $13 million. And like, it just didn't work, right? So I only share that as hopefully some data points on valuation that folks might not have as much insight to on a day-to-day basis. But what about you at the earlier stage?
I have a question real quick.
Yeah.
How specific, and maybe this is more of an early stage question for Ryan, but how specific do you guys want the entrepreneur to be in terms of this is exactly how we're going to spend every dollar, or how should they lay that out, or how do you require them to lay that out?
I think it's very important. I mean, the use of funds is a very important thing because we need to see that, well, A, you're not going to run out of money, in 6 months and be having to raise again, because that's probably one of the least things we want to see is that, every 6 months you're going to go out and raise because, every time you raise, it's going to be 2 to 3 months of fundraising and you're not really trying to grow your business at that point. You're just sitting here going back to the trough, trying to get more and more. So I think the use of funds is very, very important, and you need to get down to like, a lot of it comes down to, are you going to have more employees? Are you going to, what are you going to pay them, et cetera? What new technology are you going to implement? What's that going to cost? And then I think the timing of when that money goes out is a very important thing too, because then you start to lay out a plan, and probably when you're fundraising at the seed level, you should already have in mind of when your next fundraise is going to occur and or when you're going to become cash cash flow positive, so that you know you're not gonna run out of that money.
All I care about is the milestones.
Yeah.
In terms of where you're gonna use the money, I think it totally depends. But it's all about what milestones are you gonna hit before your next raise. Because if you either don't have the milestones, and to Ryan's point, you go through the cash, like, you can die like that, right? Because you'll be burning cash, you wouldn't hit your metrics, you go out and like, it just doesn't hit, right? So it's more about the amount of capital you're getting. Is that gonna get you to where you need to be? So I think to me it's less specific about like, this is exactly like, you know, I'm gonna hire one marketing head, or like, this is where I need to get. And I think that I'm gonna need this many bodies across this many areas, and that's gonna make it happen.
My phone is beeping because my wife is uber pregnant right now, and that's why I'm checking. No offense to.
Tell her to wait 15 months.
Yeah, I know. It's not her, so I apologize. Yeah, thanks, Phil. Any other questions? We should probably get into the next topic.
Which is what?
I think we're going to chat quickly about some successful tactics. And,
Yeah. So before we move on to that,
Yeah.
I'm sure people get the deal structure piece. Everyone's set on that. I think
Oh, yeah.
the only point I think that we're trying to get across is just kind of know when you should go out, right? So if you're, you know, if you think that your company is going to be valued somewhere in the, you know, $3 to $4 million range, you can probably sustain $1 million check. If you think it's a startup and it's going to be $1 million pre-money, like, don't try to go raise 5. I mean, it just kind of doesn't.
Yeah.
It sounds basic, but we see a fair amount of that stuff. So getting into the tactics, and this is probably the one point where there's more opinion than observation. I think the best thing, and I mentioned this earlier about trying to have a business that doesn't require capital, I think that if you can either have a company that is break even or has the image of being able to get break even, or you've raised some money and now the company's close to break even, that's absolutely the best tactic you can ever have, is to be out talking to investors when you either don't need it or you can at least pretend like you don't need it, or you don't want it, because it just totally changes the dynamic. Because people don't feel like they're funding a payroll, people feel like they're funding growth. And whenever there's that semblance of like, hey, I don't need it, it tends to come, right? So I think that's probably the first piece of advice I would give. Again, harder, easier said than done. Then the second piece I would say is know your business, not your pitch. I think the pitch is totally, over, it's like kind of glamorized. I mean, people are like, it's all about I have to perfect this pitch and let me get my presentation down and what's my exit strategy and all that other sort of stuff. And I think that just know your metrics, know your business, go sit down and have a conversation. And again, this is a little bit biased to us, but I mean, we've invested in companies that didn't even have pitch decks, right? But they knew their business, they articulated it to us, and we were able to work through the finer points. I think sometimes people will come in and it's kind of like they've had a theater coach. And that stuff just doesn't matter. Now, obviously, there's a linear relationship on that between your pitch and how much traction you have. If you've got a pre-revenue idea, it probably matters, right? Because you need to be able to thoughtfully articulate that. But to the extent you don't, I would say focus on getting customers, not making PowerPoint slides.
Yeah, I think the glamorization of the pitch is completely overblown. With us, and a lot of the tactics that's worked with us is people who get to know you before you really need to raise money. Like, the first time you meet a venture investor or any investor shouldn't be the time that you're pitching them to get a check. I think it's a matter of planting the seed and letting that grow, because if you come on hard and saying like, hey, look, we're raising this round, we need this right now, are you in? It's like, whoa, like, slow down. Just get to first base here, before we go too fast. But I mean, it is a bit of a dating game, and the dating game can go really fast, no doubt. Like, we just score right away, if that's the thing. But on the other side of it too is like there's stuff we have to do on our end that takes some time to make sure that we can run those bases safely. So I would say the more you can get to know the people and get to know their trust and respect, I think the easier the process is going to be, so that the timing of when you do want to go to them, the timing is right, they already know what's going on, and then you can really just kind of ease into that conversation. But make it a genuine effort to get to know the people too, and not just like the, hey, I know you're writing checks, and let's I'll buy you coffee or something. But I think it's a matter of like, hey, you really need to have that relationship and really get to know the business beyond that. And I think you'll get a lot more out of the VCs beyond just the money side of it too. Like, there's a lot of introductions, there's a lot of potential customers, there's a lot, even if we invest, there's a lot of other people we can introduce you to. And I think that's the whole other side of getting to know the people before, you actually have to raise the money. There's a lot of other stuff that can come with it too.
Yeah, one other thing I would say before we open it back up for questions is I don't think there's ever been a better time to be an entrepreneur in trying to raise capital. I really don't. I mean, we talk about all the stuff about how it's more cost efficient to get a business up and running. It's more cost efficient to acquire customers than it was 10, 15 years ago or whatever. There's easier access to investors. I mean, just like tweet at people, right? Like, you can tweet at Brad Feld or Suster or like Hunter Walk or us locally, right? People will get back to you. People list their email addresses on their website. I mean, it's so frictionless in terms of access. That doesn't mean it's always going to work out, but there absolutely are tools out there. And I really think the power shifted back to the entrepreneur in a major way because of those trends. Like of the stuff we described on, B2B software companies with lots of customers and bootstrapped, like it sounds like totally bogus as if it doesn't happen. Probably seen it happen 20 times of companies get funded in the upper Midwest in the last year. Like it does happen, it is possible. In all those cases, there are multiple investors trying to get in. And so I think that's probably the biggest thing that we'd hope people take away today is it's more accessible in terms of communicating with investors, take advantage of it, reach out. The good ones, I shouldn't say the good ones, but the ones that are easy to interact with typically will get back to you in a short amount of time. So I think that's all we had. If anyone has any other questions. The last one is, yeah, in the back.
I lived in Austin and also in San Francisco and then here in Minneapolis. And one of the things I know that seems to be missing here in Minneapolis, or it used to be here, maybe isn't anymore, is kind of those core companies that have growth stories that churn out people who have the money to do the angel investing that you were talking about. Right? If you think of all the Dellionaires in Austin and all the stuff that's come from that, including Austin Ventures itself, for example, and of course, stuff that's been going on for 40 years in Silicon Valley. What do you think is that the way that we can change that here, or how could we potentially, short of one of your companies becoming a $5 billion company and therefore doing that, which would be great, obviously, but what do you think is the right answer? Because I don't think there is as many people who have rich aunts and grandparents and things like that around that are going to be able to seed those angel markets before you guys get involved.
I think there's more of it happening than we think.
Okay.
And I think it's going to happen more. So I think a great example is you funded Compelling, right? Mm-hmm. Did you do Zyotech too? Mm-hmm. Okay, so those companies, I mean, Compelling grew out to be what it was like a 900 something.
Yeah, it went public first.
It went public and then it was quite right. I mean, take that example, right? So Phil Soren was the CEO of that company. He's done, and then he becomes a venture partner at Icon Ventures in town, and does a lot of stuff philanthropically, right? Like, I don't know Phil that well. I met him a few times, but like, it doesn't get any better than that. Like, that's what you want people to do. I think what we also need are more companies going for the long term. Like, you have to think a company like Code 42 has had options to be acquired, right? I don't know those guys, but you have to think a company that's doing that well has had those chances. But I think that when you see companies turning down those chances and going big and going for the long haul, I think that really matters. And I think that the more we do that and the more we kind of take that risk, the higher the likelihood people will come back and invest. But the flip side of that is that doesn't happen all that often, right? So we have to be patient. Like it might take, 10 years to build a great company. Our firm was birthed out of Great Plains Software, which was in North Dakota. And like Doug grew the business over 20 years. 20 years. Now the impact of that company has been he's hiring interns right now that are children of people he hired into Fargo when he was running Great Plains Software. And he was just happy that they came to Fargo, right? But those people stayed, they became leaders in the community. They made some money, they're giving back and investing. So I think that we're seeing more of it. There's probably more happening than we think, and I think that it's going to continue to be that environment to take more risk and try to pass on like the $50 million exit and go for the $1 billion or whatever, or whatever it is. Does that make sense?
It does.
And I don't think we're far off either too. Like the writing's on the wall for quite a few big companies around here that could exit. And I think then when that happens, then there's going to be a whole new wave of fresh entrepreneurs and capital that can really go back into the system. So.
And I think it matters too, though, because like I feel like some people, and Compelling I think is a great example. I've heard multiple people be like, oh yeah, but they got acquired by Dell, right? Like, oh, it's too bad they're not around anymore. And like, I think that's totally bogus, right? Like, do you think in Chicago people are like, Braintree was acquired by, was it PayPal? What Braintree? Was it eBay or PayPal?
PayPal.
PayPal? They bought it for like $800 million. Do You think right now everyone's like, oh wow, that's a bummer. They're like, hell no, we got, Braintree got acquired for 800 million. They're like, they're celebrating that. So I think we need to have that outlook as well. What else? Anyone else?
I was curious, we're actually leaning toward the seed fund background where I feel like the stage 1, 2 stuff maybe almost more glamorous.
Yeah,
So I'm just, I was curious what personally you got, what got you more interested in the seed funding side?
sure. So the way we look at our investment approach is we like to do a lot of little investments across a big swath of that. So for me, I'm a serial entrepreneur on the back end, so I like to chase some shiny lights and see a lot of different stuff. And that's a great way for me personally. I really like to kind of work with a lot of different people across a lot of different areas. So that's what made it very interesting for me. And I think there's a real opportunity here in the Twin Cities. There's a real lack of knowledge on how to invest at that seed stage, especially in the tech companies. So I thought we could really fill a void in that market and or provide some sort of guidance to really help direct some capital into that area. So it's interesting. Yeah.
There's a question about
You guys are in the early stage rounds. Do you expect to be part of the follow-on rounds? Or do you assume that you're just going to hand it off to another?
Yeah, no, we'll always reserve. But given the size of our fund, I mean, we're hoping to be participating in successful future rounds, right? Versus being like the de facto A. So like, yeah, we absolutely will hold capital back. But I mean, if we're doing a $2 million round, and then the company is going out and they want to raise 5, we wouldn't have the capacity to do the entire 5, right? But our goal is to be able to participate with that. Yeah, I mean that's basically the way that we look at it.
So, and for us, we typically put our money in, and then we have some held back for our investments, but other ones we don't. So it will be a mix.
Do you both take board seats?
We don't require board seats, but I serve on a couple boards. Yeah.
I would say of all the deals we've done, there's been a board seat associated with the round. Since we work with other firms on some of those, it's not always us. The one that we did, that was the safe deal. We didn't put a board together. Yeah.
What do you see the valuations of the last couple of years? Have they stayed consistent, down?
Yeah, I've only really been looking at it for probably 18 months. So I don't have a ton of historical, view on it. But I would say that they're definitely higher now than when we started.
Yeah.
I think it's a pretty frothy market right now.
Are they higher for SaaS than other stuff, or is that?
I think SaaS is by far the highest for SaaS.
SaaS is easiest to value. So yeah.
And I think that's, again, largely for the revenue and cash predictability. But yeah, I think SaaS is by far the
range
richest.
on that is 4 to 10 times?
What's that?
Is the range on SaaS 4 to 10 times?
Yeah, well, so I think the multiples come more into play the more you mature, right? Because at the early stages, pretty much every company that you talk to, they'll be like, hey, I shouldn't be valued on a multiple because I'm growing so fast. So like, it's great that like Marketo trades at like whatever they are, 8x or something like that, but I'm growing way faster than them. But from what we're seeing right now, we're seeing for competitive deals, we have seen about 10x run rate. So I mean, we've seen deals that are about 40K, about 400K in annual, in run rate. We've seen those deals get priced somewhere between, 3.25 to 4.5 pre, scaling up to $1 million run rate, being high single digits, closer to 10. I have no idea if people are looking at that on a multiple basis, but before I came today, I just kind of mapped some deals that we've seen, again, that we've done and have not done, and they kind of shook out in that range. But I would consider that healthy for the entrepreneur. Cool. Oh, one more, Lois.
Yeah, that's fun.
Talked about getting to know the people and relationship-wise, even before you're asking for the dollars. To what extent does that getting to know incorporate discussions around things that are just in the idea stage? Do you want to have discussions with people about ideas that they have not yet begun to act upon?
I mean, I think it depends on what their intention is for the discussion. If they're asking for just general advice or market, or I think if there's specific things in the discussion, then yeah, that's fine. If it's just like, hey, I want to get to know you type thing, well, I do those, every day across the board. So I think there's the intent of what the discussion to be. If it's very specific around that stuff, and if we can provide value outside of writing capital, then I don't see a problem. But think it would also be up to them to know if like we can provide any of that value or not, based upon, you know, the type of stuff that we're working with currently.
If they want to talk about like funding and stuff like that, I would say yes. Otherwise, I would say have them talk to another entrepreneur, because the last thing anyone should do is come ask me what they should build for their product.
Yeah, and
Otherwise, I'd be doing it myself.
yeah, so you should go talk to a customer. Yeah, it's probably your best bet.
Yeah. Well, cool. Well, thanks everyone.
Yeah, thank you.